Chapters 7, 8, and 9, Lecture Part 3. We're going to go over long-lived assets. In other words, property, plant, and equipment. That's what it's called on the balance sheet. It's also another term for fixed assets. So, classifying long-lived assets or fixed assets. Long-lived assets can be categorized into two different assets. One are tangible assets, and the other one is intangible assets. Let me give you some examples of tangible assets. They are land, buildings, equipment, furniture, vehicles, computers, and natural resources. So tangible means things that you could actually physically touch. So those are all things that you could physically touch. An intangible asset is an asset that you cannot touch. Examples include patents, copyrights, franchises, licenses, trademarks, and goodwill. So these are assets that you cannot touch, but they are still considered assets. In both cases, they are, again, long-lived assets, which are assets that benefit the company in the long term. So what's the determination of a fixed asset? This is a helpful chart to help you determine that. Step 1, is the purchased item long-lived? If it's no, then it's actually considered an expense and not an asset. So you want to debit expense instead of debiting asset. If yes, you go to step 2. Is the asset used in normal operations? If no, then that's actually considered an investment. If it's yes, then yes, it's considered a fixed asset. So two things there. It needs to be long-lived, and it needs to be used in normal operations for it to be considered a fixed asset. Measuring and recording acquisition costs. Acquisition cost, this is important because it's not just the purchase price of the asset that gets recorded, but other things as well. So along with the purchase price, you want to also include the sales tax, if there were any legal fees involved, transportation fees, and installation, and preparation to get that asset in working order. So if you were to purchase a fixed asset and it included all those things, you would add them all up, and the total is what you would debit that asset for when you record that asset into your accounting records. I included a chart here for cost of acquiring fixed assets. There's building. So if you acquired a building, it would include all those costs that I'm checking off right now. If you purchased machinery equipment, it would include all these costs that I'm checking right now, or bullet points. And then if you purchased land, you would include all these examples of costs into the recording of land. So building, machinery, equipment, and land are all long-term assets. If it's a land improvement, those are the examples there. But land improvements are not, repeat, are not an example of a fixed asset or a long-lived asset. That's just improving something like land. All right, we're going to get into expenditures. So expenditures deals with repairs, maintenance, and improvements of fixed assets. Types of expenditures? Well, there's two. And we're going to get into that right now. So a type of expenditure is an ordinary repair and maintenance. Those are the characteristics on the second column. And it needs to maintain the productive capacity of the asset during the current accounting period only. It needs to be recurring. It involves only small amounts. And this is important, number 4, do not increase the productive life and operating efficiency or capacity of the asset. So the accounting treatment there is you're going to expense everything. Think about a car and the oil change. You're just going to expense it because an oil change is just a normal periodic thing. The next type of expenditure is improvements. So here you increase the productive life, operating efficiency, or capacity of the asset. It occurs infrequently, meaning once in a while, and involves large amounts of money. Here you're going to capitalize it. So this is where you add to the asset account. I actually like this next chart better. So costs related to the fixed asset. All right, if it benefits only the current period, like that oil change that I was talking about, that's actually called a revenue expenditure. Normally, you would just debit the repairs and maintenance expense account. So just little things to keep the fixed asset going, and it happens periodically. It doesn't cost that much. In contrast, it benefits the current and future periods. So if you do something to the asset and it benefits it for the current and future period, then it might be two things. One is considered extraordinary repair, where it extends the useful life of the asset. Then that's considered a capital expenditure, and you want to debit accumulated depreciation. The next one is asset improvement, and it adds service value to the asset. That's also considered a capital expenditure, but in this case, you want to debit the fixed asset. This is very important here if it's a capital expenditure, because you are actually altering the existing record for a fixed asset for their fixed by actually debiting the fixed asset itself and crediting the related accumulated depreciation. Now let's get into depreciation. This is the main topic of the chapter where most of the calculations are coming from. Depreciation, you have to realize that it is the decrease of usefulness of an asset. So here, usefulness of fixed asset decreases. Let's say you purchased a computer today. The usefulness of that computer over time will decrease, and that's called depreciation. Or let's say you purchased a vehicle. It doesn't stay new, but after wear and tear, it depreciates or its value decreases. That's what depreciation is. Here, I included a chart where and how the balance sheet and the income statement gets affected because of depreciation. When you acquire the asset, you record it on your balance sheet. That's where it says acquisition cost. And then when you allocate the cost of that asset, you want to expense it on the income statement. There's a breakdown right here. You debit depreciation expense on the income statement. You credit accumulated depreciation on the balance sheet. So those two things right there is what you record when you record depreciation for a fixed asset. Depreciation expense is an expense, and accumulated depreciation is a contra asset. Let's go over types of depreciation. A company must choose what type of depreciation they're going to use. Once they choose one, they must stay with that one because it's required by law and it does have tax implications. The first and easiest depreciation we have is straight line depreciation. If you see that SL, that means straight line. The second type of depreciation we have is units of activity. Units of activity depreciation. This is sometimes referred to as usage of activity depreciation? It means the same thing. Next, we have double declining balance depreciation. There are other types of depreciation, but I'm only going to focus on these three right here. It's what the chapter focuses on as well. So double declining balance depreciation. This is also called an accelerated method of depreciation. And if you see DDB, that's double declining balance depreciation. So it's an accelerated method of depreciation. We'll get into each one as we go through different examples. I also created this graphic here comparing the three types of depreciation: straight line, double declining balance, and units of production. That's another term for units of activity, units of production. So straight line, double declining balance, and units of production method. If you look here, there's different periods. I got 4 different periods. You start out with the book value, which is on the balance sheet, and after each year, you depreciate it. Under straight line, the depreciation is the same each year. If you notice, it just adds up. And if you look at the squares, they're exactly the same. That represents the same amount it's being depreciated each year. Usually take the book value minus the depreciation expense, and you'll get your, or accumulated depreciation, and you'll get your net book value. So again, the book value minus the accumulated depreciation equals your net book value. You do that each year, and that's what's reflected on the balance sheet. Whatever's remaining, that's called the salvage value or the residual value. Now for double declining balance method, that's an accelerated method, meaning there's a lot of depreciation going on in the beginning years or the beginning periods. If you notice, the squares are a lot larger the first couple of periods, and they get smaller as you go through over time. As I said, the net book value is calculated by the book value minus your accumulated depreciation equals your net book value. So again, book value minus accumulated depreciation equals your net book value. Whatever you have left over at the very, very end of its life, that's called the residual value or salvage value. The units of production, the squares are all kind of different because that's based on how much the asset was used, and it can differ from one period to the next. One thing remains the same for all of them is on the balance sheet, you want to have the book value of the fixed asset minus the accumulated depreciation, and then you'll end up with your net book value. To understand the concepts of depreciation a little more, we're going to go through examples of each types of depreciation. The first one we'll go over is straight line depreciation. Here's the example. The cost of equipment, I should just say equipment, is $340,000. The residual value is $20,000. The useful life is 4 years or 1,000 hours. And then the equipment was used for the following amount of hours for all 4 years. There it is. For straight line depreciation, we need a formula to be able to calculate the depreciation per year. The formula is pretty simple and straightforward. It is the cost minus the residual value. If you see the term salvage value, it means the same thing as residual value. So it's cost minus residual value divided by the useful life in years. Once you calculate that, you will get your depreciation amount, or how much it has decreased after each year. So here's our calculation. Let's take the cost. The cost right now is $340,000. The residual value is $20,000, and its useful life is 4 years. So 4 years. 340,000 minus 20,000 is 320,000 divided by 4, which gives you $80,000 per year. What does that mean? It means that each year that equipment goes down in value on your books, on the accounting records, by $80,000. So you have to decrease the value of that asset by $80,000 each year. It's important to note that you do not decrease the equipment account. You keep the equipment account at $340,000. Instead, we're going to use an account called accumulated depreciation, which is right below the equipment account. Our journal entry looks like this: December, year 1, whatever year that may be, 31st, you're going to debit depreciation expense for $80,000, and then accumulated depreciation dash equipment, because that's what we purchased, for $80,000. Notice we debited an expense that belongs on the income statement as stated earlier, and actually helps you out on your taxes because it will lower your revenues and you'll be taxed less on net income. Accumulated depreciations on the balance sheet, and I'll show you how that's illustrated right now. So here it is, the balance sheet. We have equipment we purchased for $340,000. The contra asset is accumulated depreciation, and it's listed right below that. And after the first year, it was $80,000. It's a negative because it's a contra asset. Its normal balance is credit, whereas all other assets' normal balances are debit. So you take the difference between the two. So the net book value after year 1 is $260,000. On the income statement, what does that look like after putting this journal entry in? Well, you debited depreciation expense, so expenses belong on the income statement. You'll just have depreciation expense $80,000. Again, just big picture, that helps with things like taxes because it will lower your revenues and give you a lower net income. I'm going to do 2 years worth of depreciation here. In year 2, it's exactly the same as year 1. December year 2, December 31st, you debit depreciation expense and you credit accumulated depreciation dash equipment. For each fixed asset, you're going to do this. You got to signify or note which fixed asset you are depreciating. And again, because we had that simple formula, it's still $80,000. So $80,000 in year 1, it went down, and then another $80,000 in year 2, it went down again or decreased in value by $80,000. Let's look at our balance sheet at the end of year 2. Our equipment still the same at $340,000. Our accumulated depreciation is no longer just $80,000, but the sum of the 2 years together, which in this case is $160,000. That accumulated depreciation is always increasing in value because you keep recording or crediting accumulated depreciation every single year. Now our net book value is lowered. It's now at $180,000, and your depreciation expense on your income statement is $80,000. How come that's not $160,000? Because remember, closing entries. At the end of each year, we close expenses, dividends, and revenue. And the first year's depreciation expense was closed to retain earnings, so that's why it doesn't accumulate. Next, we're going to do an example for usage of activity. Depreciation method. We're going to use the exact same example. Sorry for the grammar there, but the cost of equipment is still $340,000. Residual is $20,000. Useful life is 4 years or 1,000 hours. Now the equipment was used for a certain amount of hours each year, and this information on this problem becomes very important. In straight line, we didn't need to use that data, but here we need that because we're actually going to use that information to get our depreciation amounts each year. Just like the first example, I'm going to do 2 years worth. Before we get into it, I do need to list some steps. So this is not as easy as straight line depreciation. There are a couple steps, so it's not too difficult. But the first step is to calculate the usage rate. The second step is to use the usage rate and multiply that by the actual usage, which again is the data up top. You see it. where the equipment was used for a certain number of hours. Those are actual hours. So multiply the usage rate by the actual usage. To calculate the usage rate, by the way, on step 1, here's the formula. It's cost minus residual value. Very similar. The numerator is very similar to straight line depreciation, but the denominator is different. Instead of dividing by useful years, you're going to divide it by the estimated total usage, which in this case is 1,000 hours. So now let's calculate the usage rate, which is step 1. The usage rate is cost minus residual value divided by the estimated total usage. The cost is $340,000 minus the residual value of $20,000. You divide that by the estimated total usage of the asset, which in this case is 1,000 hours. So 340,000 minus 20,000 is 320,000 divided by 1,000 hours. It will give you a rate of $320 per hour. So that's saying that each hour your asset will decrease by a value of that much each hour. So for year 1, after year 1, it's no longer an estimate, but it's actual hours the equipment was used, and it was used for 280 hours. You're going to multiply that by the usage rate, which is $320 per hour, and you will get $89,600. As you can see, every year is going to be different because it depends on the actual hours the equipment was used for. So let's do our journal entry, December, year 1, December 31st. You're going to debit the same thing that we did before, debit depreciation expense, and then you're going to credit accumulated depreciation equipment. And you're going to do that for $89,600 debit and $89,600 credit. So $89,600 debit, and again $89,600 credit. There, you recorded the depreciation for that equipment after the first year. Here's our balance sheet. Equipment was worth $340,000. Underneath it, it's your contra asset, accumulated depreciation. This is only the first year, so our accumulated depreciation after a whole year is what our journal entry is, $89,600. The difference between the two is called net book value. And right now we have that at $250,400. So that is our net book value. For our income statement, we have depreciation expense of $89,600. $89,600. Now let's go to the end of year 2. Realize that this is always at the end of the whole year. So end of year 2, if we look at the problem, 260 hours in second year. So after the end of year 2, it's determined that the equipment was actually used for 260 hours. You're going to go back and multiply that by the $320 per hour rate. That will give you $83,200. Notice there's a difference between the first year depreciation and the second year depreciation. This is not straight line method. This is usage. Okay, so usage, it depends on the actual usage or activity. So our journal entry is on December 31st. Your journal entry is really not that difficult. You're always debiting depreciation expense and you're always crediting accumulated depreciation dash whatever the fixed asset is. In this example, it's the equipment. So $83,200 and $83,200. Let's reflect that on our balance sheet. Our balance sheet, our equipment was originally $340,000. $340,000. Our accumulated depreciation is, remember, it's in the word or the title of the account name, accumulated. It accumulates. Originally we had $89,600, and then we recorded some more. In this case, it's $83,200. $200. So you want to add those two values up, and together they equal $172,800. It's a negative because it's a contra asset, meaning its normal credit, its normal balance is a credit. Take the difference between the two, and that's called your net book value. That equals $167,200. On your income statement, you want to debit depreciation expense for the $83,200. And that is your usage of activity depreciation example. Next, we'll go over double declining balance depreciation. It's the same example as the previous two. The cost of the equipment is $340,000. Residual value is $20,000. Useful life of 4 years or 1,000 hours. And the equipment was actually used for a certain amount of hours for those 4 years. Before we get into the formula, there are steps that you must take to calculate double declining balance. So here I'm going to first list the steps, then we'll get into the calculations after that. The first step is to calculate the straight line rate. I know we're working on double declining balance, but as part of the steps, you must calculate the straight line rate. The straight line rate is 1 over or divided by the useful life in years. We'll do that in a second for our example, but let's go over the steps first. The second step is whatever you get in step 1, you double that amount. So double the straight line rate. And that's why it becomes the double declining balance rate. And number 3, you use a formula. The formula is the following. Cost minus accumulated depreciation, there you go, times the double declining balance rate, which you get from step 2. And those are our steps. Now let's go over our calculations in respect to this example. Step 1, find the straight line rate. The straight line rate's pretty easy to do. You take the number 1 over or divided by the useful life in years. In this case, the useful life is 4 years, so 1 over 4 equals 0.25 or 25%. The next step is double that rate. Double whatever rate you got or calculated in step 1. In step 1, we calculated 0.25, so you simply multiply times 2, which will give us 0.50. So 0.50 is our double declining balance rate. In step 3, we're going to do calculations or plug it into our formula for each one of the years. So let's start with year 1. Year 1, the cost is $340,000, and you minus the accumulated depreciation. But there is no accumulated depreciation in year 1 because you just attained that asset, so it's always 0 times the double declining balance rate of 0.50, which will give you $170,000. In year 2, same formula, $340,000, but now you have accumulated depreciation from the first year, which is $170,000, so subtract that, times the double declining balance rate of 0.50, and you'll get $85,000. Year 3 is the year that you got to watch out for. A lot of people make a mistake here. It's $340,000 minus the accumulated depreciation. It's not just 85, because that's a common mistake, 85,000, but you're going to add what's been accumulating thus far. So it's 170,000 plus the 85,000 from the 2 previous years. You'll get 255,000 times the double declining balance rate of 0.50, and you will get $42,500. This asset has a 4-year life, so always, right before the very last year, do not put it into the formula. Instead, compare what you have thus far to what you can depreciate in full. Here's what I'm talking about. Calculate the depreciable amount. The depreciable amount is the cost minus the residual value. So the original cost was $340,000 minus the residual value of $20,000. That will give you $320,000. We're doing this because we have to remind ourselves that we can only depreciate this asset up to $320,000 because our net book value at the end needs to equal 20,000. So again, we're going to compare what we can depreciate up to, which is 320,000, versus our depreciated amount so far, our accumulated depreciation of $297,500. The three depreciation amounts added together from the first 3 years. The difference is $22,500. So in year 4, you don't put it into the formula in the very last year. Instead, you take what you can depreciate up to, which is 320,000, and that amount is $22,500. So if you add all those 4 amounts that I just double underlined, that will get you to $320,000. Again, golden rule, never ever calculate the very last year in respect to putting it into the formula. Now I'm just going to quickly fill in the 4 values we calculated for all 4 years. I'm going to fast forward the video. Please look at the PDF if the video goes too fast for you on this portion of the example. As usual, we debit depreciation expense and we credit accumulated depreciation. For the first year, it was $170,000. I'm going to reflect that on the balance sheet. And just like we did in the previous types of depreciation, equipment is listed at the original cost at $340,000. Accumulated depreciation is $170,000, so your net book value is $170,000 after the first year. The income statement is a depreciation expense of the same amount, $170,000. Second year, again, it doesn't change. The debits and credits will always remain the same. Debit depreciation expense, credit accumulated depreciation. We calculated $85,000 for the second year. Let's reflect that on the balance sheet. Equipment is $340,000. Watch out for accumulated depreciation because it's not just $85,000, but you must add the $170,000 from the first year, and now your net book value is $85,000. On the income statement, it's depreciation expense for the $85,000. As a reminder, it doesn't accumulate there because we close expense accounts at the end of the year. Year 3, debit depreciation expense and credit accumulated depreciation equipment. We're going to use the amount that we calculated. It's $42,500 and $42,500. Let's reflect that on the balance sheet. Equipment is still $340,000. Your accumulated depreciation thus far is the 3 years worth of depreciation all added together, which is $297,500. Now your net book value is $42,500. Your depreciation expense is what you did your journal entry for. In this case, it's $42,500. In year 4, we just did a comparison between our accumulated depreciation and our depreciable cost. It's still the same debits and credits. Depreciation expense debit, credit accumulated depreciation. And this time it was $22,500. Let's reflect that on the balance sheet for the last year. Equipment is $340,000. Accumulated depreciation is $320,000. And look, the net book value is $20,000, which is your residual value in the problem. Debit depreciation expense on the income statement for $22,500. And there you have it. That is your double declining balance. Please remember, be careful on the very, very last year or right before the last year, because you do not, or you usually do not put it or plug it back into the formula. Next, we're going to go over depreciation for a natural resource. Here is our example right here for a natural resource. Bling Mining acquired mineral rights for $60 million. It's a diamond deposit. It's estimated at 6 million tons. During the first year, 1,500,000 tons were mined. During the second year, 1,800,000 tons were mined. This is very similar to the usage of activity depreciation, where you calculate a rate and multiply by an actual amount. So let's get into it. Let's do steps first. So steps. Step number 1, you want to calculate a rate. So calculate a resource rate. It's not a usage rate because we're not using the diamond, so I'm going to call it a resource rate, or just you could state it as a rate. And then step 2, you want to multiply the actual resource that was mined by the resource rate from step 1. Step 1 has a formula, so let's go over the formula for step 1 in calculating that rate. So formula for the usage rate or the resource rate. You're going to take the cost. So you're going to take the cost of the mine divided by the estimated total resource. Notice that we don't subtract any salvage or residual value because there is none. So cost minus the estimated total of the resource, which in this case is the diamonds. All right, our calculations, we're going to take our cost, and the cost was for the diamond mine is $60 million. And you're going to divide it by the estimated total amount of the diamonds, which is 6 million tons. This will give you a rate of $10 per ton. You're going to take that rate and multiply it by the actual amount of diamonds that were mined. In the first year, 1,500,000 tons were mined. So you come to the end of the year 1, you know the actual amount that was mined, which again in this case is 1,500,000 tons, times your rate, which is $10 per ton, equals $15 million. We're going to go to the journal. It's the end of year 1 on December 31st. Normally we would call the debit depreciation expense, but because this is a natural resource, it's termed a little bit differently. It's called depletion expense instead. So depletion expense is $15 million debit, and then you credit accumulated, not depreciation, but accumulated depletion for $15 million, and that's specifically for diamonds, so $15 million. Let's reflect that on our balance sheet. Your asset right now is diamonds, and the diamonds worth or costed you $60 million. You want to decrease it by the accumulated depreciation, or I apologize, accumulated depletion of $15 million. That's also a contra asset, just like accumulated depreciation. And the difference between the two is your net book value. As a reminder, net book value is not an actual account. It's just the difference between two accounts, just to show it and reflect it on the financial statements. The difference between the two is $45 million. On the income statement, you'll have a line called depletion expense for the amount of the journal entry, which is $15 million. Next, let's go over year 2. Year 2, again, you're going to take the actual that was mined. In this case, it's 1.8 million tons, or 1,800,000 tons. That's our actual. And then you're going to multiply that by the rate that was calculated. So 1,800,000 tons times your $10 per ton rate, which will give us $18 million. We're going to make this adjusting entry at the end of year 2. So it's going to be December 31st, end of year 2. Depletion expense is our account. Instead of depreciation expense, it's depletion expense because it's a natural resource. That's for $18 million. Our credit is accumulated depletion dash diamonds. also for $18 million. We're going to reflect that on the balance sheet just to show you what it looks like. The diamonds originally cost us, or the mine, which the diamonds are at, originally cost us $60 million. Our contra asset in this case is called accumulated depletion. Remember, it's not just the 18 million, but it's also combined with the previous year's depletion, which is 33 million altogether. And then your net book value will give you $27 million. Your income statement will have the depletion expense line for $18 million. And there you have it, depletion for a natural resource. Next, we're going to go over disposal of assets. We're going to do this pretty quickly, so please review it more in detail in the ebook or textbook. When you update depreciation expense to the date of disposal. So that's the first step. There's really two steps, and then you're going to record the disposal by the following. One way is to record cash, so debit cash, or paid, cash received, debit, and then or paid credit. And then you write off the accumulated depreciation debit. The second way is record a gain. If you're recording a gain, you credit for a gain and you debit for a loss. And then to write off the asset, you credit the asset cost. In a nutshell, you want to credit the asset itself, so it goes to zero, and then debit the accumulated depreciation account, so it also goes to zero. And then record the loss or gain as shown on the chart. The last slide we're going to go over is intangible assets, which I went over at the beginning of this video. Here are some examples of intangible assets. The first one we have is a trademark. If you want to think about a trademark, we're talking about logos, names, trademarks that protect products and companies. The second one is a copyright. That is written compositions. We're talking things like a book or a song. Patents are ideas. A good way to remember that is drug companies create drugs and they patent the drugs, or electronic companies that create electronics a certain way. Goodwill is the amount of assets minus liabilities, and the difference between that and what a business sells its business for. That's goodwill, because there's going to be a difference there. Licenses are a value of licenses. And franchises, if you want to think about franchises, it's the right to sell a certain product. McDonald's is a franchise, Chick-fil-A is a franchise. Those are owner-operated places where they must follow certain rules set forth by the corporations that provide things like how to make the hamburger, how to show how the menu should look like, how things should be prepared. Those are franchises. The owners of those businesses must pay the corporation a certain amount of money to be able to open up that restaurant, make the food that is promoted and sold. Please review more in detail regarding intangible assets. For intangible assets, we do depreciate them, but we don't call it depreciation. We actually call it amortization. So it's the term used to, I'm going to put depreciate in quotes, depreciate these intangible assets. Each one of them have certain types of rules, so you might want to review that in the textbook. On the exam itself, I'm going to focus on the other types of depreciation of fixed assets and natural resources, but I'm not going to go too heavy on the amortization of intangible assets. So we're going to go, this is actually the very last slide. It's additional topics to review, like I said just now. Please review the accounting for intangible assets and also see how fixed assets and the depreciation related to them are reflected on the balance sheet and on the income statement.